the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, here's a quick recap of some of the key movements. Well, Singapore shares went up today, even as investors remained laser focused on the situation in the Middle East. Now, the Straits Times Index was up 0.4% at 3,894 points at about 1:33 p.m. Singapore time, and that is with a value turnover of some 668 million Sing dollars seen in the broader market. Now, we do have the closing numbers now, so let's take you through them. The STI closed up 0.65% at 3,904 points. In terms of value turnover, we are looking at 1.35 billion Sing dollars. Now, gainers outnumbered losers, 346 versus 174. Top advances for today, we've got for you GMHUSD, UOB and DBS. And top decliners, we've got ASUS, Multicam and ST Engineering. Well, in terms of companies to watch for today, we have OCBC because the lender said yesterday that it has no intention to convert its Class C non-voting Great Eastern shares into ordinary shares when they come up for conversion in 5 years, because this will result in the insurer losing its free float again. Now, elsewhere, from easing fears of an energy market shock to how Nvidia's chief Jensen Huang started selling the chipmaker stock under this $865 million plan, we've got more international and corporate headlines in focus. And joining me on the line today is Chong Serjing, co-founder and portfolio manager at Compounder Funds. Serjing, how are you?
Hello, Jensen. Thanks for inviting me. Happy to be chatting.
Great to have you. And Serjing, lots happening around the world today, but earlier today, Asian shares gained, oil prices were down following U.S. President Donald Trump's announcement of a ceasefire between Iran and Israel. Now, there are, of course, claims about violation of that ceasefire, which Iran had denied. So really, for how long can the positive momentum we saw in Asia today be sustained, and what are the levels to watch for oil then?
Yeah, so I think from a humanitarian standpoint, we definitely hope that there can be lasting peace between Iran and Israel. Mm-hmm. As for the equity markets, I'm not sure how long positive momentum can be sustained because of the peace talks. But if peace can be sustained, then I think it's a big positive for equity markets because, with peace, there's just more people that can channel their energies into improving the world. And over the long run, I really think that it is human ingenuity in terms of trying to improve the world that really fuels the global economy and drives the equity markets. So I always like to say that investing in stocks is ultimately the same as having faith in the long-term ingenuity of humanity. And so if there is lasting peace, then that provides the fertile ground for human ingenuity to flourish. You also mentioned oil prices, right? Yeah. So I think it's incredibly difficult to predict the movement of oil prices. So around 3 years ago, I actually did a study of oil prices, and I found that there were about 5 major crashes in the price of oil from 1980 to 2021. As a commodity, I think it's logical to think that differences in the level of oil supply and demand would heavily affect its price movement. So when demand is higher than supply, prices would rise and vice versa. But data from BP, which was formerly known as British Petroleum and is today one of the largest oil-producing companies in the world, this data show that from 1981 onwards, demand for oil was higher than supply in every year. Okay. So what this also means is that the price of oil had experienced at least 5 major crashes over the past 4 decades, despite demand for oil being higher than supply in every year. Mm-hmm. There's this organization called the Energy Information Administration, or EAI, in the US that also has a similar database as what BP has, and it also shows a similar result. And so, I guess the question is, how can there be oil consumption being outweighed? How can oil consumption outweigh production for decades? So my friend actually communicated with the EAI, and it turns out that there could be errors within the EAI's data, and I assume that it will be the similar case for BP as well. But even after realizing that there could be errors in data, where it's still really difficult to tell what the actual demand and supply dynamics were for oil during 1980 and 2021, when there were those 5 major crashes in oil prices that happened. So I think it's just really difficult to tell what will happen to oil prices.
I know it's very difficult to tell where things will go going forward, a little bit like a crystal ball depending on the situation. But looking at today's price movements when it comes down to Asian markets, when it comes down to oil prices, do you think investors are looking for a reason, looking for a trigger for positivity, so to speak?
I guess your question really boils down to whether or not investors are trying to find any positivity in the news that's out here in the world today. Am I hearing you correctly?
Yes, correct.
Yeah, so I think there's another aspect of the financial markets that's interesting, and it's this phrase that markets tend to climb a wall of worry. So it's this idea that, there can be bad news that happens all the time, and yet why are markets continuing to rise? And I think it's also because if you look back over a very long period of time, I think it's also undeniable that there has been many improvements in the global economy in terms of living standards, in terms of the types of products and services that companies have been able to produce over time. And I think that has really been the most important thing to focus on, in my opinion. Right. So I think it's only natural that over a long period of time, that markets would climb a wall of worry because, yes, there is bad news happening all the time, but again, bad news is what would capture the attention of news readers. While at the same time, there are many good things that are happening in pockets of the world today, but the cumulative effects of these good things take time to show up. Compounding needs time to show up.
And if we go back to the Singapore stock market as usual, Serging, I know you look at the long term, but just for today, how far did the STI track regional movements and any surprises when it comes down to the biggest movers and the sectors that they lie in, say, oil and gas players?
So I don't see anything that is out of the ordinary with the movement of the Straits Times Index. Like you mentioned, the index closed the day up about 0.6 or 0.7%. And most of its constituents have movements within a band of plus 2% or minus 2%. I see that as being a very normal range of movements.
Okay. And if we could zoom in on some of the counters to watch for today as surging, we have OCBC, because OCBC said yesterday that it has no intention to convert its Class C non-voting Great Eastern shares into ordinary shares when they come up for conversion in 5 years, because this will then result in Great Eastern losing its free float again. And the comments come as OCBC responded to media reports on how it can still propose the privatization and delisting of Great Eastern by converting these non-voting shares to ordinary voting shares. What do you make of the news, and what does this mean for investors of OCBC really?
So this is the latest piece of news regarding the privatization of Great Eastern by OCBC, and I think it started all the way back last year when the bank first made an offer to acquire its insurance subsidiary. By choosing to not convert its Class C non-voting Great Eastern shares into ordinary shares when the 5-year timeline is up, I think it seems that OCBC's intention is for Great Eastern to remain a public listed entity if the delisting resolution fails on the 8th of July this year. So I think for investors of OCBC, I don't think this piece of news moves the needle in much in any way. So if we take that Great Eastern is successfully privatized, OCBC will have to fork out about $900 million for the shares that it currently doesn't own yet. And this is a drop in the bucket for OCBC. It has total assets of currently about 625 billion Singapore dollars. Right? And as it stands, nearly 94% of the economics of Great Eastern already belongs to OCBC. Right? And so for some perspective, 6% of Great Eastern's $8.7 billion in shareholders' equity is around $500 million. So that's the extra shareholders' equity that can potentially accrue to OCBC in the event of a successful privatization. But OCBC's shareholders' equity is already currently $59 billion. So even if you add that additional $500 million, it's not going to be moving the needle much.
Okay, I see. Now, if you're just tuning in, we're now in conversation with Chong Serging, co-founder and portfolio manager at Compounder Fund. Well, Serging, another counter to watch for today is Lam Chang, because it's interior fit-out business Lam Chang Creations launched a preliminary prospectus for Catalyst listing on the SGX yesterday. Now, the move followed its spin-off from Lam Chang finalized earlier in June. So, how far will the move benefit Lam Chang if we look at the counter's price movements on the main board of the SGX today?
Lam Chang's stock price has definitely had a strong positive reaction today. I think it's up about 7%. Now, as for whether the positive reaction can be sustained, I think it will depend on the future business performances of both Lam Chang Creations, or LCC, and the remaining businesses within Lam Chang. So when a business is spun off from its parent, what it gives to the shareholders of the parent is the potential for value to be unlocked. So for example, if the spun off entity is fast growing and is doing well, the market would then be able to better recognize the value of the business that was spun off. And this can lead to the combined value of the spun off entity shares and the parent shares to be higher than the value of the parent shares prior to the spin-off. And I think this appears to be what Lam Chang's management is trying to aim for. So the idea for the spin-off was first communicated to the public in November 2024. And in the announcement, management commented that LCC had, quote, demonstrated strong growth in recent years, end quote. Right, and that LCC also had outstanding value of construction work yet to be reported as revenue of about 178 million Singapore dollars. So it's unclear what the duration is for that order book, but it's probably somewhat needle moving for Lam Chang as a whole if the spin-off had not happened, because Lam Chang had reported revenue of about 239 million Singapore dollars for the second half of 2024. Right, so but ultimately, whether the spin-off is a long-term positive or non-event for Lam Chang, I think it will depend on the future business performance of LCC.
Yeah, I see. And if we look at Lam Chang's price movements today, it closed up some 7.35% on the SGX. Well, further away, surging US President Donald Trump, he said that interest rates in the US should be lowered by at least 2 to 3 percentage points today. And that is ahead of Fed Chair Jerome Powell's testimony before Congress. What do you make of the comments? And also, when Powell testifies before the Congress, what would you be keeping your eyes on?
So I can only speculate as to what Donald Trump wants with the Federal Reserve when he talks about wanting the Federal Reserve to lower interest rates. And I think he wants that to happen because he thinks that U.S. government bond yields will be lower if the Federal Reserve cuts interest rates. But the problem here is that the Federal Reserve controls only one interest rate in the U.S., which is the federal funds rate. Yeah. And the federal funds rate is the interest rate that banks in the U.S. charge each other for overnight loans. Most government bonds have interest rates that are set by market forces and not the Federal Reserve. So a great example can be seen sometime in October 2024 when the federal funds rate was lowered. And at that time, the yield on US 1-year, 10-year, and 20-year treasuries all increased. Right, so the Federal Reserve doesn't actually have that much power over longer-term government bond yields, which is, I think, what Trump's administration is focused on. So it kind of really puzzles me as to why President Trump is so fixated over what the Federal Reserve should be doing with interest rates, because I think what he's trying to achieve is very different from the interest rate that the Federal Reserve actually controls. So that is with regards to the Federal Reserve and interest rates. As for Powell's comments before Congress, I don't watch the Federal Reserve's actions that much in my investing activity, so I have no opinion. And I have this stance because I think the Federal Reserve does not exert as much power over the US stock market as some people think. So for some context, the 3-month Treasury bill is a close proxy for the federal funds rate. So time periods when the interest rate on the 3-month Treasury bill increased would also be times when the Federal Reserve had actually raised the federal funds rate. So as it turns out, according to data from Ben Carlson, who is an investor at Ritholtz Wealth Management, from 1954 to 1964, the yield on the 3-month Treasury bill rose from 1.2% to 4.4%. So that's a time period where the Federal Reserve had actually raised the federal funds rate. And yet the S&P 500 had produced a stunning annualized gain of 21% in that period. And if you look at the 1970s, the 3-month Treasury bill's yield actually rose from 8% to 12%, and yet the S&P 500 was up by around 6% per year. So there have been past episodes where US stocks have done well over the long run, even when the Federal Reserve was raising interest rates. But there's also been times where US stocks have done very poorly in the following 12 months after the Federal Reserve had cut the federal funds rate. So according to data from Joshua Brown, who's the CEO of Ritholtz Wealth Management, the Federal Reserve had cut interest rates in October 1973 and September 2007. These are just examples of time periods where the Federal Reserve had cut interest rates. And in the 12 months following those time periods, the S&P 500 was actually down by 36% and 24% respectively. So there are, in my opinion, many aspects of the US financial markets where the Federal Reserve have little to no control over.
Okay.
So I don't spend that much time looking at what the Federal Reserve is doing.
I see. Well, finally, before I let you go, Serging, we must look at Nvidia, because Nvidia CEO Jensen Huang, he has started selling the chipmaker's stock. The first transactions under a plan that allows him to offload up to $865 million worth by year's end. His plans are disclosed last month in Nvidia's quarterly report, a calculated move. But what do you make out of it? Does it suggest that the current price levels are optimal for Huang to cash out?
So while $865 million is a lot of money, I think that amount also needs to be put into some context. I think in the introduction to our current session, you mentioned that Jensen Huang's net worth is estimated to be about $126 billion and that most of it comes from his holdings in Nvidia shares.
Yeah.
Right, so I think if you compare $865 million with $126 billion,
small change.
The sale, exactly. So I think the transactions here, they are just a drop in the ocean, and so I don't think there is any useful signal in what he's trying to do at the moment.
I see, and certainly lots to watch in global markets every day. Thanks so much for the insights, Serging. That was Chong Serging, co-founder and portfolio manager at Compounder Fund. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.